see where we end up. Disclaimer, nothing we say is advice. Don't be silly. We're just two guys having a chat from one hemisphere to the other. And Justin, I'd like to start today with I was told there would be a uranium bull market. Have you seen that meme? So maybe we can pick it up from there. That's where I think a lot of uranium guys are at right now. Maybe you can tell us what's happening in terms of the fundamentals versus the sentiment, and we'll pick it up from there.
Sure. Yeah, I was told the same. No, it's, if you zoom out, both for generally speaking equities, let's say the ETFs or the large caps in the space that are more liquid, this has been a very, very long and relatively steep pullback that we've experienced really over the past year. We had a decent rally off the lows of last summer following the news of Microsoft's deal with Constellation and the restarting 3 Mile Island. That was a decent, 30, 40, 50% rally over the course of those few months. And then another really, gut-wrenching pullback since then, late November, early December, all the way until pretty much the last 2 weeks. We started to recover a bit. For the commodity itself, we're absolutely in a bull market, especially when you're looking at the long-term price for uranium, which is really the price, the real price for the industry. The spot price is what we all look at because it's the only thing that has any sort of regular visibility to investors. So that's what we watch. It does matter. I'm not the voice in the industry saying that the spot price is utterly irrelevant. It's absolutely relevant because it has an influence on negotiations for long-term contracts. It actually is oftentimes referenced in these contracts at the time of delivery, the spot price or some kind of blend of term and spot, or an average of the last 3 months of spot, whatever market reference portion of contracts has some relation to the spot market typically. So it does matter, but it isn't where utilities procure most of their needs in terms of fuel, right? So uranium being the first step in the fuel cycle. With all of that said, if you zoom out at the long-term price, it's been basically a steady move up from about $30 to here at $80 since it bottomed in 2017. So that has been in a steady and slower bull market. And interestingly, if you look at the term price, it goes through these fits and starts as well, where it'll consolidate for, let's say, 8 to 12 months or so and not move much. Maybe it moves down $1 or up $1 or two, but not very big moves. And then we have these waves where the sentiment shifts not only in the equities market, and risk on equities absolutely does affect this market. It affects the physical market and vice versa, right? But you have a shift in sentiment. The buyers step in, the sellers step out, the price moves up significantly. And then you have a period of 8 or 12 months where the term price will go up 30, 40, 50%. Then it consolidates again, and then it moves up again. And that's happened 3 times since the bottom for the term price back in 2017. So the term price for uranium, which is the real price for the industry, is continuing in a bull market. And we're actually about month 8 or 9, maybe even pushing month 10 for that consolidating period of the big move that we saw, let's say mid to late 23 into mid 24. That was a big move for the term price of uranium. Now we're nearing what we believe is going to be closer to the end of that consolidation, and the next leg is going to come. I can't tell you if it's tomorrow or next week or next month or next quarter, but it is coming because there's enormous uncovered needs for utilities. So this very broad, long-term, zooming out bull market is absolutely still happening. We have a long ways to go. Along the way, we have gut-wrenching pullbacks, just like we just experienced. So anybody that is new to this sector or is considering putting money to work, you have to understand it's an extremely, extremely volatile sector. You have to either be very, very on your toes about trading or be willing to hold through very large pullbacks and knowing that that is the price you pay for outsized upside potential when risk is on. It's a very small market. When money pours into this sector, you can see extremely, extremely strong moves to the upside. And when it's really has a lot of momentum, like we saw, let's say December 2020 through November 21, and then we saw again mid 23 to early 24, enormous runs for the equities. And we expect we're going to see another leg for this market this year.
Yeah, I'd like to reiterate this because I was talking to Uncle Rick last week, and he's often going to make the point around not one speculator in a thousand understands that whilst everyone is looking at the spot price for this commodity, all the action and long-term contracting is happening in the term market. So we've seen I guess the main reference would be the SPUT the SPUT holding vehicle for the spot price, and that's dropped off what, let's call it 30% over the last year. It was over 100, and now we've had a severe correction. But with the term price, what are you using as a reference? Is it what is put out by UEC every month? Because that would be the lowest reference contract point on that reporting date, right?
So the long-term uranium price is published by both UXC and TradeTech. These are kind of the two primary nuclear fuel consultants, and their primary clientele is the utilities, even though a lot of investors pay for their work as well. That price is published at the end of the month. So UXC will publish the last Monday of the month, which and the same thing with TradeTech. And that price, you're right that price. Now, TradeTech does a little bit more of a blending price, and exactly what informs the price that they print is likely proprietary on their end. But UXC publishes the low offer, and largely what the term price is a starting point for negotiations. So right now we have both UXC and TradeTech reporting an $80 a pound long-term price. Just today in the spot market, we had a couple of trades done at 64.50. So that's where the spot price is relative to the term price. And that low offer usually represents the floor in long-term contract negotiations. So oftentimes you'll see smaller volume, let's say midterm contracts that might be base escalated. And usually a base escalated contract is something that a developing company would entertain because it's more of a fixed price contract that's escalated based on an agreed upon percentage that's referenced from, expected CPI or whatever it might be, right? And interest rates. But that low price is what's printed. So oftentimes, back in December, we had NextGen report that they had engaged in 5 million pounds of contracts with a couple of large North American utilities. First delivery in 2029. And those had floors, $79 floors, and supposedly $150 ceilings. So that's a very, very high ceiling when we're talking 64.50 spot and $80 term. To expect that pricing range from 79 to 150 at the time of delivery just 4 years from now. So those types of contracts really are sort of pointing the way. This was agreed upon between the utilities and the 2B producer of NextGen. So that's sort of where the industry understands that the price will be heading. Everybody kind of knows that there's going to be continued upward pressure on the price, but we will go through these periods of time, like the last 12 months, where after a huge run up, utilities are like, okay, this got out of hand pretty quickly. Got a bit of inventory. We've got some uncertainties. At the time, it was primarily the Russia situation and legislation that had not yet been signed by or passed by the Senate or signed by the president, which eventually became law in August. That was a big concern for US utilities. But you also now have Trump admin overhanging uncertainties in addition to, peace in Ukraine, peace with Russia, what that could look like. Will that happen? Exactly what that means. A lot of spinning uncertainties. So in the meantime, when the trend is down for the spot price, utilities will largely step back, and that is what we've seen. Decent amount of contracting in December and January, but a lot of that seemed to be longer term negotiations that were happening over many months that got inked. Still, we're far away from seeing a very robust, full year of replacement rate plus in contracting and a bona fide contracting cycle, which really still hasn't happened, which is crazy to say that considering that the uranium prices basically bottomed late 2016 into 17. And here we are 9 years later. Where's the contracting cycle? Hasn't started yet. And a lot of people are like, okay, well, maybe it's never going to happen. Maybe your thesis is wrong. Well, the prices have responded, and the price doesn't respond to the upside in an oversupplied market. We worked through an enormous amount of above ground inventory. Now it's a very, very, very thin market, and it's not going to take a lot of demand to move this thing again.
Yeah, indeed. So if we're thinking that there's been some support for a floor around the mid 70s, flexing up to a ceiling of around 150, why would that be happening if there's this secret threat of oversupply or even a balanced market out there?
Yeah, and there's not. There's no real secret supply out there. I would argue that the quietest supply is probably enrichment sold from China to the Western utilities. It happens in very small volumes, and the Chinese are net buyers and net importers of enrichment. So the only enrichment they're selling is what they're buying from Russia, and that has limited capacity. And it's been small volumes, less than 10% of the overall needs of the U.S. utilities have been bought from China over the last 2 years. It's just been a mechanism to shore up near-term needs. Meanwhile, am I getting my next shipment for Russia or not? I don't know. That's very concerning to me. I'm going to buy EUP where I can. Uranium, it's a later problem. My problem right now is conversion and enrichment, and that's been the big story of the past 2 years. And clarity there. A lot of people think that peace between the US and Russia and an ending of the war in Ukraine is bearish uranium. It's absolutely not. I don't know whether or not the equities will react negatively to that announcement, but it's absolutely bullish for uranium. It removes uncertainty, and that is the one thing that idles utilities action more than anything. Removes uncertainty. It opens back up the availability, or let's just say the acceptability of Western utilities to engage in business with Russia, potentially. There probably are still going to be certain utilities that will voluntarily not do so. But we have limitations in the US under the Russian suspension agreement. And the amount of enriched uranium that has come into the US over the past 2 years hasn't changed. So this piece happening there will not change what the US will be able to import. All it does is remove that uncertainty and allow the utilities to come back to the table and focus upstream. Upstream meaning uranium. Now that they've been putting a lot of focus into conversion and enrichment because of that disruption over the past 2 years, uranium comes next.
Yeah, you said the word upstream. In my mind, I'm thinking that we're focused too far out in terms of the ripple effect. So people are focused on the yellow cake price, and be it spot or term. But that's not what actually goes into nuclear reactor to generate the fuel. So if you look at the SWUs and the highly enriched uranium, perhaps you can comment on the price action there, and then I want to come back to this idea of replacement rate. So where are we at in terms of the SWU and the enriched uranium price versus the spot?
So the price for conversion has spot conversion went from single digits at its low point in the late 20 teens all the way up to north of $100 per kgu for conversion. That is an enormous price move. Now, term conversion hasn't moved as much. Spot conversion is like, I need conversion tomorrow or within 12 months, but that's kind of tomorrow in this industry. And term conversion is like a term contract for conversion, like it would be for uranium delivery or for enrichment. Enrichment has moved up a lot as well. Enrichment, I believe, has tripled, and conversion a bit more than that on the spot side. But they've doubled, more than doubled, and more than tripled in the past 2.5 to 3 years. It's been a huge move. And honestly, peace between US, Ukraine, Russia, likely if we see more global players voluntarily engage with business in Russia, we could see the enrichment price drop, and that actually would be good. Buying more enrichment from the biggest player in that. And in Russia, even though they are the single largest player in conversion, it's their enrichment that's really kind of the linchpin in the industry. So they're like 40% of global enrichment. They're the biggest player by far. I think they're only 28, 29% of the global conversion. Still the biggest player. But Russia's a net buyer of UF6. Even though they're the biggest converter, they're a net buyer of US6 because the demand for their enrichment is so great. So a price moving down or more availability for enrichment would actually be very, very good. With that said, we've never seen demand increase downstream to conversion and enrichment and see a big price response there, and not seen that happen to uranium as a follow-on move. So really, very basically, you're buying enrichment as a service, you're buying conversion as a service. Those two services need feedstock. You have to feed uranium to the converter, and then that converted uranium, the UF6, has to feed the enrichment process. So Some of that uranium is covered, some of it is not. All of these conversion and enrichment contracts that have pushed the price up in the past 3 years, many of those still need feed delivered to the converter. So that's what we think is going to happen next.
Well, that seems logical to me because it's a highly path-dependent pathway. You can't get to the end stage without going through all of those processes of the feedstock and the conversion. In terms of incentive price for new production, where would you estimate, say, a greenfield or even a brownfield project to be restarted? What kind of what kind of price per pound would those guys need in order to either start or restart production? And how long would it take for those pounds to come to market?
It really depends on with the project, right, and the jurisdiction, and the type of deposit that's being mined, right? You have ISR projects that are typically lower cost, and the big ISR projects that are feasible largely are in Kazakhstan, following up into Uzbekistan. We expected much more growth from Uzbekistan a couple of years ago. They have recently updated the market within the last 12 months, basically saying rather than seeing a doubling of their production going out into the 2030s, that maybe they'll achieve a 50% increase. So we're modeling for that. They're kind of like Kazakhstan light, but they don't have anywhere near the resources that Kazakhstan does in ground. Kazakhstan has a decent amount of growth, but most of that looks to be, and this is according to the company themselves. You can look at what they're projecting for their own growth, and they're still shooting for 32,000 tons, which is 82, 83 a million pounds per year. It's a lot of uranium. We don't think they're going to hit that number, but they're putting a lot of focus into both their Chinese and especially the Russian joint ventures. And the big project, Budenovskoye 6 and 7, that's getting all of the focus in terms of the available sulfuric acid, the excess sulfuric acid. It's all going there. Russia needs a lot of uranium. They don't have a lot of uranium. They have a lot of conversion and enrichment, not a lot of the uranium feed. When you're talking about greenfield projects, those can be broken up into kind of two categories, right? You have the dry mines in the US, which are very high cost. You have the large open pit projects in Namibia, which are lower grade and inherently higher cost than some of the ISR projects. So you have like Tumas, Etango, there's a couple of others. These are bigger projects. They're at later stage of planning and moving towards development of those projects. Supposedly, we're going to hear a final investment decision for Tumas from DPLO in the next couple of months. We're very curious to see what Mr. Borshoff has to say, because this was supposed to come back in December, and he told the market, we don't like the pricing dynamics here. We're putting a pause on this. So you have those greenfield projects. The legacy producers right now, talking about incentive prices, you have Kazatomprom is the big one. Kazatomprom and their joint ventures on a 100% basis, they're the biggest producer, right? And individual attributable basis, they're also the biggest producer. But even in the country, they've raised these mineral extraction taxes so substantially that you hear Cameco saying their production costs in Inkai are in line with MacArthur and Cigar in Saskatchewan, which are enormously complex underground mines, and these have such high grades that they can still pull the material out of the ground for probably less than $50 a pound. But now Inkai, which is ISR and historically extremely cheap because of these mineral extraction taxes and the difficulty of shipping west by subverting going through Russia, it's basically in line and on par with their Canadian projects. And even Cameco is telling the market, we can expand MacArthur River. Nameplate at Key Lake is 24 million pounds. We can expand MacArthur River from 18 to 24 million pounds a year. We're not doing that yet. We don't have enough contracts at prices that work for us, which tells you right now what you have is Kazakhstan working on expansion, Uzbekistan expanding a little bit. You have US ISR projects kind of slowly moving into production. Australian ISR projects are slowly getting there as well. And you have the developing projects like NextGen's Arrow and Denison's Phoenix. And there's some marginal stuff in Africa, some marginal stuff in Brazil that's taking years and years and years and years to get over the line that arguably could be slightly profitable at these prices. But there's multiple projects, expansion of brownfield for Cameco, dry mines in the US, dry mines in Africa. And these things are absolutely needed to balance the market based on the demand projections that we have going out into the future. So incentive price, the price right here, that's what you have. Some expansion in Kazakhstan, a little bit of progress in the United States, big development projects in Canada, which are not guaranteed. Still no shovel in the ground for NextGen's Arrow and Denison's Phoenix. Expected that they will produce, but just last week we had news from out of Canada that the governing body in Canada, the CNSC, is saying that there will be two hearings prior to potential permitting approval for Arrow. One in the coming months, the other one in February of next year, which means even with the optimistic timelines coming from NextGen, let's say they do get their permit following the second hearing next year, shovels in the ground mid 26. They're giving a 42-month development from first shovel in the ground to first cake in the can, 3.5 years for the largest uranium mine ever built, including the mill. Okay, that's their timeline. That puts first production, let's see, mid 26. That puts first production in 2030. If everything goes perfectly smoothly for the largest uranium mine and mill ever built. Now, will that happen? Probably not. That's not a knock on the company whatsoever. Mining is hard. Uranium mining is really hard. So the news of last week compared to what we knew even 6 months ago was first production in 2028. Now it's first production in 2030. And that's a meaningful project when it comes to a balanced market that I can guarantee you utilities believe is going to come online on time and on budget.
Okay. So I'm hearing that really only at this stage, the expanding production is in the east, and those pounds are highly likely, let's say, to remain in the east. They're not really going to be available pounds for the Western market as such. You mentioned demand. Let's talk demand and supply. So at the moment, reserve replacement rate, let's say for the utilities, where would you estimate that to be, and how much contracting have we seen last year? And I guess we're nearly coming up to the end of the first quarter of this year.
Last year, we had approximately 185 to 190 million pounds of demand, and that is based on the operating fleet globally and calculating out at 475,000 pounds of burn per gigawatt per year based on a 0.24, 0.25 tails assay and a product assay of 4.5%. That's our assumptions for demand, and that's pretty industry standard for the people that model this stuff. That also includes the triple demand of initial core loads for new reactors that connected to the grid. So that has to be included in the modeling as well. So last year, let's call it 185-ish million pounds of demand, and we had about 150 million pounds of supply. We had a contracting level of 106 million pounds last year.
Okay.
So yeah,
Quite a gap.
yeah, exactly. And really, you have to when UXC model supply and demand, what they have is, and this is important to understand, UXC, they'll always show the market as balanced because reactors aren't shutting down, right? They are achieving continued operation. So to say that there is 30 or 40 million pounds short of supply relative to demand, while that's true in terms of mine supply, something is filling that gap, right? So what is that gap? That gap largely is some inventory drawing down, mobile inventories that were still, kind of in excess from the previous decade. There's not a lot of that left, but it's still around a little bit. But largely it had to do with flexing up on contracts from producers. So producers have a bit of inventory. Oftentimes they're producing a little bit more material than they actually have in committed deliveries because in previous years in these contracts, oftentimes there were, up to 20% flex provisions in these contracts where the utility could say, okay, I signed this contract at, let's say in 2022, 2021, I signed this contract at 40% reference to the market at the time of delivery and 60% fixed or base escalated at $45 a pound. So now here we are, delivery time frame has come, and you've got 60% of this contract fixed at 45 bucks a pound. Spot is 64, term is 80. What are you going to do? You're going to get every pound you can out of that contract. So all of these producers have been flexed up on. And this is one of the reasons why the market is so tight. There's just not a lot of material out there because Cameco, Kazatomprom, Orano, Uranium One, everybody's been flexed up on with these legacy contracts. And you've seen evidence of that with Kazatomprom. Their production has increased over the past few years, and their inventories are at 10-year lows. So there's not a lot of wiggle room in this market any longer.
Okay, so it kind of sounds to me like the case in the oil market with the IEA and the case of the missing barrels every year. So you're saying there's a little bit of extra production that doesn't necessarily get captured in some of the numbers, and the difference between what's contracted in the supply demand numbers is the flexed amount, if I understand
That is
correctly.
one portion of it, right? There's also
Okay.
secondary supplies. So we model for 23 million pounds of secondary supply this year. That's underfeeding from enrichers. That's mixed oxide fuel. The French recycle some fuel. That's a little bit of government, based down blending, which has a little bit of material coming into the market every year. A little bit of inventory sales from the Japanese, a model for 3 or 4 million pounds of that every year. And this has been, all of these things have been in existence year over year. So this is not a new phenomenon that's going to pause this market. This is something that is always there, and we've seen the price respond amidst that. So yes, there's always a little bit of flex, but there's an enormous amount of inventory in this industry, right? There's what, 1.5 billion pounds of inventory, but that's held largely, almost 99% of that is held by utilities. So they don't really sell that material basically ever. There's very few utilities that trade material. Almost all of them buy it, move it through the fuel cycle, and it goes in their reactor. That's their job. You also have sovereign and military inventories. So those big numbers include pounds that are held for strategic reasons, not only for military, but if you have a grid that's highly reliant on nuclear, oftentimes you'll have sovereigns, governments hold inventories. So these inventories are largely not for sale. When we have prices move up and move down and fluctuations in the market and equities risk on, risk off, can some of that stuff shake out in the market? Yes, but the reverse is true. When you have supply uncertainties and rising prices, you'll often see inventory restocking. And this is one of those things that's difficult for the investor mind to understand because we've had it pounded into our heads, and what makes sense is buy low, sell high. So you see, okay, the price is off here from 106 spot to 64. Why isn't everybody in there buying? It's just not
Yes.
how the utilities operate. They have one job, to keep the reactor fueled. If the trend is down, they have no incentive whatsoever to attempt to catch that falling knife. But when the trend reverses, if they have some uncovered needs, they do have a little bit of that, quote unquote FOMO. Okay, the bottom looks like it's in. Now it's moving the other direction. Some of the people that were offering up pounds over the last 6 months have pulled back. They're not in there selling anymore. So that affects the price and the trend moving back up. And they oftentimes, when there's certainty for their operations going forward, when the trend is up, they'll step in and they'll buy more. And the opposite is true when the trend is down. So utilities don't have an incentive to try to time the bottom in a price trend.
Yeah, it is highly counterintuitive that you would, in fact, think that you'd want to procure more fuel at a lower price. It kind of reminds me of Western gold investors. Like they sell when the price drops and they jump back in when the price rises. So in terms of what's on my mind in terms of what it's going to take for utilities to come to the party and start procuring more pounds, is it in fact a rising price and that you mentioned FOMO, that panic of the inability to secure their pounds into the future needs?
So a couple of things I should mention here. And I don't feel like I answered your previous question fully. I wanted to mention one other thing, but it goes well with your last question, which is this industry exists, it lives in the future. And it's too complicated by far. And this is why nobody does it. The specialist funds that have 20,000 hours into this, they don't do this, right? They model the sector the same way we do, which is you have to take a snapshot view of a single year. You have to go into the future and predict what reactors will be operating and how much they'll be consuming, and you have to predict how much will be coming out of the ground in supply. With that said, utilities coming into the term market this year, they're not buying uranium largely for next year. They're buying uranium for 2028, 29, 2030, 2031, even into the mid 2030s, right? They're thinking that far into the future. So you'll have some market observers on X, let's say, that will show a supply and demand graphic and say, okay, the market looks largely balanced according to this person's work until 2030. This is a 2030s story. No, a 2030 insufficient supply matters right now. Matters right now. And there's multiple examples of this. OPG, which is shovels in the ground last year for building the first BWRX 300s in Canada. This is a small modular reactor from GE Hitachi. It's supposed to be operational in 2031. They bought uranium last year for that project. Last year, 2024, 7 years before they need the fuel. Hopefully that it comes, they build it on time online, because that's a lot of interest in the BWRX 300s. So demand in the 2030s equals demand in the market right now. Most utilities are fully covered for their needs next year, 2027. Like, you can actually see this graphic from Yellowcake. They model it, and every time they update their presentation, you can see the uncovered needs of utilities. And, it just goes down to the right at a 45-degree angle. Tomorrow they're covered. Most utilities have the next core load on site, and sometimes 2 core loads on site. And then their inventory is across the fuel cycle at various converters, right? So the future is now for this industry. And when you see huge deficits in the 2030s from supply, that's a problem right now. It's like you're in a tunnel and you can see the lights of the train that's half a kilometer away coming at you, and you can hear it honking its horn. It's just going to take a minute to hit you. Now, to actually answer your last question about, we're here for the investment thesis, the equities, mining equities, theoretically, are leverage on the rising uranium price. And the reason for modeling this out is, if there's insufficient supply coming into the future, it's going to be generally supportive of the price continuing to rise. Our base case is not a moment of absolute panic and we have a nickel moment where the price triples or quadruples over the course of a month. That's not something we want to happen. We are advocates for this industry. What we want is the price to continue to rise to the point where it doesn't completely disincentivize utilities, which it can go much, much higher. And I can get into those numbers in a minute if you'd like, before it really is like, okay, we've got problems with our operations. But we want it to rise sufficiently to incentivize the development project so that this market can balance and we can see a significant growth of nuclear. And that is what we believe will happen. Ultimately, even though we see in our model a striking situation starting especially in like the early 2030s, right? And this, of course, assumes, Kazakhstan gets most of the way into their ramping of their production. This assumes that there's 10 greenfield projects that we have in our model that come online between now and 2030. 10. That's a lot, okay, that haven't even put a shovel in the ground yet. So these things need to happen, but half of them aren't happening at this price. And that's really the core of the thesis. Nuclear power plants are very, very expensive, very, very important pieces of infrastructure that are highly, highly valuable for national security and, just survival of a culture, right? That you need to have these things operating. That's the base case. And it's pretty easy to model the demand. That's what's wonderful about this sector. Tell me what the demand is going to be 8 years from now in the oil market. I mean, maybe you can model it, but there's also these voluntary players like OPEC, like, we're going to increase, we're going to decrease. Okay, we can model what that demand looks like, very accurately. Going out 5, 6 years, you start to get into some assumptions beyond that, because China is going to have reactors operating in 2033 that they haven't started constructing yet. 100% they will, because they're building these things in 5 years. But that's what's unique about this commodity, is you can accurately model demand. And supply, we know what's out there. We know what's out there. We know what is in development. We know the likelihood. We can make educated guesses as to the likelihood of the timeframes of that supply to come online. So our base case is not the industry is screwed and we're going to $500 to $1,000 uranium. That's not the base case. The base case is we're going to get to true incentive price, which here is north of $100 a pound term price, and it's got to stay there for a while. Then we're going to have these higher highs, higher lows from spot that goes on these crazy spikes and comes back down. We're going to see more of this. This is absolutely not over, and it's not going to be over until we have supply coming in sufficiently to keep that demand satiated and the price stable. And we actually don't know how that's going to happen at this point. We don't see where that marginal production can come from. We needed $100 a pound term 2 years ago. That's what we needed in order for this market to truly be balanced. So while we don't want industry panic and we're not planning for an enormous spike based on a panic moment, that is possible. And there are very, very smart people that have been following this industry for longer than we have that we speak with who believe that there will be a moment where certain utilities aren't going to get their fuel. This is possible. If that happens, all bets are off where the price goes.
Highly interesting. And in that scenario, I understand that some of these physical holding vehicles who said that they wouldn't be able to sell some of their pounds actually would then be able to sell and redeem some of their units. I'm thinking of John Champalia and SPUT. Do we actually have clarity around what circumstances might enable their selling some of their physical holdings?
So SPUT is an interesting one. They technically can sell a small amount of pounds to shore up their balance sheet. They have never stated that they would sell pounds to buy back units. That is something, I suppose, theoretically that's possible. That's not something that they seem like they're interested in doing. In a recent interview, Chipagli has said this, and they're saying this because their cash balance, I think they're down about $10 million in their treasury right now. So they're going to need cash just to cover their management fee probably in the next 3 or 4 months. So if they don't get to NAV and raise cash in their traditional mechanism, they probably will have to sell some pounds. Keep in mind, they're holding 64 million pounds and they might have to sell 50,000 pounds here or there. What is absolutely not on the table is an opening up of those pounds. And you have to remember, this physical trust exists to hold pounds. This is their mandate. It is not some vehicle that's going to trade pounds in and out. These pounds are not available for sale. Now, they might sell a tiny bit if they have to, just to shore up the balance sheet. But this is not an indicator, and he'll say this until he's blue in the face. He's been asked this 1,000 times. These pounds aren't for sale. We are a physical trust. Our investors buy the trust because they want us to hold this. They want exposure to our inventory. That's why the trust exists. Now, theoretically, could SPUT be bought? Could there be an offer to buy this trust? Yes, that is possible. But I think that comes after an enormous move for the sector. And we see prices twice what they are right now, and the equities have tripled or quadrupled or more. And then, of course, that buyout offer would have to be approved by the unit holders of the trust. So if you're a unit holder right now and the trust is trading at $21 a pound, what kind of premium are you willing to accept, knowing that that would mean 60 million pounds come into the market, which probably puts a pause on the bull market for a year, and causes all the equities to crash? What are at least for the temporarily, what are you willing to accept? A double on your investment? More? It just seems to me like a highly unlikely scenario, and a scenario that only will happen after a panic moment in the industry. And no matter what Champaglia says to utilities over and over and over ad nauseum, we're never selling these pounds. You can still talk to utility fuel buyers and say, yeah, eventually the pounds of SPUT are going to shake out. They'll come out somehow. Like, all right, well, don't hold your breath for 50,000 pounds every 6 months if they have to. Like it's not going to do anything to this market. But yeah, no. So those pounds are not for sale. The pounds held by investor interests that are eventually for sale are the pounds held by, hedge funds. So that's probably somewhere 10 to maybe 15 million pounds on the high side. I know they were selling a bit of pounds in the recent risk off December until about 2 weeks ago. The hedge funds were here and there in the spot market selling material. And eventually, will we have blow off tops where they're going to dump some pounds or extreme risk off markets to speak generally? Will they de-risk by selling uranium? Sure, that's entirely possible. Those are the pounds that are going to shake out. And in a thin market, they can affect things. But of course, they were participating in the move from August of 23 into, April, May of 24. They were buying. So it cuts both ways, those kind of pounds in a thin market.
Yeah. As you say, this industry lives in the future. One thing that's changed since we last spoke really has been how topical AI data centers and their associated power generation has become so topical. I understand that that is not so easy to model into the future, but every demand would be incremental on top of the base thesis. So, how do you see that playing out over time? I really like the thesis. The problem is we need power for these things today, and therefore I went down the kind of natural gas royalty landholding side of things. But eventually, I have no doubt that nuclear makes the most sense in order to power these things. How much of that is in your considerations in from an investment thesis moving forwards? Maybe 10, maybe longer, 20 years, presuming we're going to need these data centers for a very long time.
It's not included in our model whatsoever. It's entirely right tail. So whatever happens from, let's say, direct AI demand is total upside. With that said, the de-risking of the US fleet, for example, that largely is having to do with the increasing of electricity demand that's having a big effect from data centers, that is something. So we're modeling basically for all, except for Diablo Canyon, we're still modeling for that to shut down 29 and 30, even though it's probably going to be extended. But every other reactor that's operating in the United States right now that is set to shut down in the next 10 years, we're modeling for those to be extended. And that's not just a guess, most two-thirds of those already have applications into the NRC for life extensions. So to that extent, it's influencing the dynamics in that realm. As far as direct tech company interest in building new nuclear, that's not in the model whatsoever. We do model for a little bit of SMR demand. I think it peaks out to 2035. In 2035 at 22 million pounds a year, and the demand not starting until 2031. So we could see that. That seems to be actually conservative, and that is based on looking at everything in the pipeline globally for SMRs. They're slow to get started here. There's a half dozen that are in the early stages of development and construction. But this is probably going to be one of those kind of snowball themes that is very slow, and then it probably gets into like a hockey stick type of momentum for building these things. But we're not modeling for that, right? And going out 10 years is a reasonable time frame to have reasonably high confidence assumptions. Small amount of SMR demand there. As far as tech companies getting directly involved and sharing in the finance risk with utilities or developers, contractors to actually build new nuclear, not in our model, not in our base case at all. We know it's going to be something. Honestly, I think we're going to be hearing much, much more about this year and probably within the coming months. We know that Facebook had an RFP out to SMR developers, basically saying, this is what we want. Give us some ideas on give us your options on what we can build to meet this for building SMRs in, I think it was Washington State. Kind of hearing some whispers that that's sort of stirring. Perhaps we'll hear an announcement from them, what they decided based on those RFPs. Not really sure. Also, we continue to hear, the tech companies are out there kind of kicking the tires in the fuel cycle. I think that they are very, very seriously looking at nuclear, because when these stories first kind of hit the tape, let's say back September, October of last year, what we didn't know then was whether or not this interest in nuclear was actually real. Okay, because the obvious winner, to your point, in the near term is nat gas, probably, or the nat gas. Like GE Vernova has had enormous moves in the stock, and even though they are about 10% of that business is their small modular reactor element, they build and sell gas turbines, and that business has gone through the roof. So the demand is obviously there, but there's limiting factors with that too. I mean, you can only build gas turbines and pipelines and location risk, and like there's there's a lot of challenges. It's not like you flip a switch and all of a sudden gas solves all of our problems. That is absolutely not the case. And very, very intelligent people on the financing side of this. I was at the Nuclear Financing Summit last month in New York City, put on by the Nuclear Energy Institute, and they're saying like repeated ad nauseum by multiple people in multiple different panels with different themes. We cannot lose this AI race to China, and we can't do it with just nat gas, renewables, and storage. We physically can't achieve these goals with just that. So it's not like we don't want to because it's not meeting our clean. It's like, no, we can't do this without nuclear. That's what they're saying. So all of that is to say the tech companies, we weren't sure if their interest was just checking the ESG box in nuclear, right?
I think
Or
it's a
if
lot more than that. I think these
or if
guys
it's
are
real.
even competing amongst themselves want to have access to this electric power generation source.
Yeah. And even with that uncertainty 6 months ago, what we're hearing now is they're poking around. They're looking at nuclear. They want to know that the fuel cycle is going to be there to support it. And that news is really kind of not really in the mainstream, but they literally are out there kicking the tires in the fuel cycle. Multiple tech companies are doing that right now.
No doubt about that. And as you look, if we take a snapshot as of today, which sector of this market do you see the most value? Would it be in spot price? Would it be in explorers, main producers? Just as of today, I know it changes and it's quite volatile. Which sector has your attention more so than any other inside this thesis as we speak today?
Well, I can tell you that thus far, the developers and the large cap producers have been the best performers. And honestly, it honestly seems to have more to do with liquidity than anything. Without naming names, there's a few companies that are in the 2 to 4 billion market cap range that have very, very good liquidity that haven't produced a pound yet and probably won't produce any meaningful uranium in the next 5 years. But they have performed better than a general basket, let's say the ETFs, which hold these things also. But they've performed better. Cameco is a very unique stock because it's not just a uranium company, right? They have conversion now. They have 49% of Westinghouse, so they're involved in the nuclear, like kind of like the soup to nuts vertically integrated company. So it's unique in that way, and obviously it has a decent market cap with good liquidity. So institutions love that stock. One of the reasons it's outperformed. Honestly, I think there's some interesting things happening on the exploration side. There's some companies that have been just absolutely hamstrung financially that are continuing to do pretty damn decent work considering how much they've been crushed. The explorers and the small cap developers are trading as if the bull market never existed and never will exist again. And so I think there's a lot of value to be had in the small caps in this space because they are trading as if there is no hope whatsoever in this industry. And of course, the price is pulled back to a point where it's not really all that attractive to finance these companies to even go out and drill. Why? Why are you going to go drill and probably come up with dusters when we've got $64 uranium? Why would you even do that? So the small caps have been crushed, and you can look even just at like URNJ against URA. It's been kicked in the teeth. So I think there's a lot of value proposition there. Of course, you have to be careful with the individual companies that are not big enough to be in the ETFs, and they have to continue to dilute at lower and lower prices in order to continue to drill. It's a tough game, man. It's a tough game. I would say though, what has my interest more than anything is certain developers that have also been hammered in the market that have meaningful production in the coming years, and there's a handful of them out there right now. And so once we have the swing back to the upside in spot and term continues to move up, and you have the banks that are covering this sector come in and say, okay, now instead of modeling XYZ company that's going to be producing this many pounds in the next 2, 3 years, modeling that at $60 or $70 uranium, we can start modeling that at 100 and put that into our assumptions into our forward cash flow analysis. You're going to get a big re-rating in the valuations and the price targets for these stocks. We're not there yet. Value proposition here is purely contrarian because the market thinks this is never happening again, even though the term price is stable. And I can tell you, the people that we have, let's say, in our inner circles in this industry with the connections that we built in the last 6 years, they've been putting money to work aggressively over the past, 3, 4, 5 weeks as the sector is just sold off with terrible, terrible sentiment and an immense pressure from shorting as well. It's been a huge theme in this sector. So it'll shift, it'll move. The last 2 weeks have been a little bit of a relief, but still these things are way, way undervalued. If you believe this is going to continue to move to the upside in terms of the uranium price. And of course, we do based on our modeling work.
Yeah, and it's interesting because as Rick was saying, the difference in this commodity versus another commodity for development purposes is the term market. And as I understand, something's got to give because that will allow these guys to essentially front end load their finance and to finance these projects. But the issue is, it doesn't seem to have happened, at least not yet. But if that sort of thing could come to pass, these guys can get into production without, one would assume, diluting the hell out of their shareholders or having to really take on an awful lot of debt finance. So when are we going to see, or what would it take for this sort of thing to happen? If you've got this great deposit and it's so good, and you've got term prices that presumably would incentivize that to come to production, how are these guys not able to raise the finance they need in order to get those pounds into production? That's what's on my mind.
The projects that are restarts or are further along in development have been able to do that, right? They
Okay.
have been able to sign some contracts. And while it's interesting because you have oftentimes sort of retail speculators largely saying, oh, we love this company because they haven't signed a single contract and they only have upside to reference their eventual selling of uranium into. But when you have a project that's developing, especially if you're seeking debt financing, the banks oftentimes want to see that you have some contracts booked because that tells the banks that the utilities that need what you're supposedly going to be producing believe that you will be producing that, right? And they all also can see, oh, you've got some committed cash flow in the future. So that's why you'll often see fixed price or base escalated contracts with the developing or the restarting companies like Lotus, Global Atomic. Some of the developing ISR producers in the US have signed these type of contracts. And the retail guy is like, why aren't you signing market reference contracts? Well, you have risk. There's risk in the development. We've seen this with basically every restart or development project, right? And it's mostly been brownfield to this point in the bull market. Restarting of Langer, restarting of MacArthur, restarting of a few ISR projects in the US, restarting of Honeymoon. There's a couple others I'm sure I'm missing. These restarts have all had problems. Okay, with one or two exceptions, they've been problematic, and production is either less than was expected or came on later. And these companies have had to go into the market and buy uranium. There's risk there. So when there's risk, if you're not Cameco or Kazatomprom or Orano with JVs with both of the pre-mentioned, you have to sign contracts that are slightly more beneficial to the utility. Utilities love fixed price because they can budget around it. Think about if you're a utility and you're signing a contract that's entirely referenced to the market, you have no idea what you're going to be paying for that uranium 3, 4, 5, 6 years from now. You might be able to, and if you have floors and ceilings, which you often do, at least you can have a range there. But NextGen between 79 and 150, like how do you budget around that? But so yes, some of the companies have been able to do that, but these developing companies that haven't had a final investment decision or have not yet started actual breaking ground, they largely haven't signed contracts. Okay, NextGen, 5 million pounds. Okay, well, their feasibility study says they're going to reach 29 million pounds a year for the first 5 years of production, right? So 5 million pounds with an eventual production of 200 to 250 million pounds is a drop in the bucket. It's more of a message to the market. But yes, contracts are absolutely necessary for the health of a developing company to be able to de-risk, especially if they need financing from banks.
Coming up on the 5 minute mark, and you're talking to the royalty king. Now, if ever there was a market that seemed to be so conducive to royalty contracts, it would appear to be the very circumstances that you're describing. How come there's only one royalty co in this space so far? I mean, it seems to be a great, if I had more energy, it seems to be a great idea. I might start a SPAC, acquire some royalties, go to these guys that need some capital injection in exchange for royalty and happy days. So, how do you see the royalty space? How come there's just not the presence in this industry yet? Or is that an opportunity that you and I can discuss next time we meet in Recoleta for a
I
nice
think,
steak?
you know what, I think it possibly could be. But yeah, Uranium Royalty Company. I think it was a great idea. I think that they actually have some royalties that will eventually pay that they probably were able to buy for very cheap, right? Why there isn't more royalties? Well, first of all, it's a very small space. Most of the development projects, especially amongst the publicly traded companies, but just to speak generally, will never produce anything. Most of them will not. So that's probably one reason. The existing producers or the development projects that are highly likely to eventually produce are probably either not interested in selling royalties or the royalties are very, very expensive. So that's the reason I believe that there aren't more royalty options. With that said, the timing of the establishment of Uranium Royalty Company, I think, was very good. These guys knew what was coming, and you talk to them now, they know what is still coming, and they were able to pick up some decent royalties at decent prices that actually now look like they will eventually pay out. But I would argue history is the reason why there isn't a bigger royalty space for uranium, and history meaning go back to '03 to '07, '08, you went from 10 companies to 500. And how many mines got into production? One. So, and that market just happens so steep and so fast. It seems like it's a very different market than what we're experiencing right now. So maybe there's more opportunity there for sure. But I would argue the likelihood of a royalty eventually paying out is so low in this industry that that's probably why there isn't more speculation on that front.
I see. Well, that makes sense. Well, thank you very much for joining me today. Is there anything I missed? Is there a question that I should have asked that I forgot to ask throughout? Or is there anything you'd like to leave us with to wrap up today's discussion?
I would say the only thing we didn't really discuss is that I think is worth pondering and potentially positioning for is that we're hearing all of the right signals come out of Washington in terms of something supportive coming out of the Trump admin. So we're following the Secretary of Energy, Chris Wright, very closely. He is part of a group called Oil and Gas Producers for Nuclear. He is very, very pro-nuclear. He used to sit on the board of Oklo, which is a small modular reactor developing company. He is just last month, he toured around all of the national labs in the United States. He made a couple of press conferences from these national labs, basically stating that the nuclear renaissance that everybody has been waiting for will happen under the Trump admin. He's also stating that what we're doing right now is figuring out what kind of nudge the industry needs in order to get these things over the line. So, under Chris Wright's stewardship, the Department of Energy is working very, very hard right now to figure out what sort of policy initiatives they are going to implement in order to build new nuclear in the United States. Now, I can't tell you if that big headline is going to come tomorrow or exactly what it's going to say, even, but something is going to come in the coming months, likely, out of the Trump admin that A is going to be probably a very good headline for the industry and create some sort of market effects and market ripples. but B, is going to give some clarity to the largest market in the world, which is the US utilities, right? US utilities still, 25% of global capacity in the United States, nuclear. China will be more than us in the next 5 years, but was still the biggest market. So uncertainty around what is going to happen with the investment tax credits from the Inflation Reduction Act, which, day 1 or 2 of Trump's admin was he just paused all the funding from the IRA. But new nuclear built the interest in building new nuclear had a lot of momentum for US utilities leading up to the election because there was so much money being thrown at it through the loan programs from the DOE, the investment tax credits from the IRA under the Biden admin. And those things are kind of in question right now. What is going to happen with the investment tax credits? Will they keep them? Will they do something different that's just as or more supportive? All of these things need to have clarity for the nuclear utilities because not only are they operating these fleet of reactors, but whether or not they're going to be spending money and investing in building new nuclear affects everything else for them. So that is likely coming in the coming months, some sort of clarity from the Trump admin, and that will have a two-pronged effect. Probably, I have no crystal ball, but assuming it's a bullish initiative, which we believe it is because of how important it seems to be to them that new nuclear capacity is expanded in the US, something supporting new builds, probably going to be very supportive of the equities, but importantly, clarity will come around these programs that were established by the Biden admin, whether or not they're staying in and what the utilities can do with them going forward. So keep your eye on the Trump admin and some news coming out of Washington in the coming months.
Okay, sounds interesting. Might be a buy the rumor, sell the fact. No, just kidding, guys.
Could
Keep your
be.
eyes peeled in the nuclear space. Justin, thank you very much for joining me again today. It's always a pleasure. I look forward to catching up with you in another episode of the ROI Club. Take care, guys.